Thank you for joining Theo and I as we take you through the half-year results. We're very aware that it's been quite challenging on farm, weather-wise, over the last 5 or 6 months, if not longer. And of course, we're still recovering as farmers from the difficult low payout years 2 and 3 years ago. So of course, we're concerned about the outcome of the Danone arbitration, and we want to talk a little bit about Being Mate today, given the concerns that we have with that important investment. We'll come back to that in a moment. First of all, I want to touch on the important stuff. Where are the numbers sitting at the moment for you and I as farmers? First of all, today, the board raised the forecast milk price for the season to $6.55, so up 15 cents from $6.40 to $6.55. We've also announced a forecast dividend range of 25 to 35 cents. So that means a forecast payout of $6.80 to $6.90 per kilogram of milk solids. We're announcing an interim dividend of 10 cents, which will be paid in April. The reason we have lifted the milk price is on the back of global commodity prices, we believe, being relatively balanced. And in particular, we're seeing good balance across the whole milk powder portfolio. We are seeing in New Zealand, though, that we have had while the weather's been reasonable for the last few months on farm, and farms are looking good, we are struggling to produce milk right across the countryside. So our current forecast hasn't changed. We're still at 1.480 billion kilograms of milk solids is our forecast for the year ahead. That's 3% down on last year. And even if we have a reasonable autumn, we think that's probably about where it's going to land at the moment. So if I then look to what's happening globally, globally we're seeing, as I said, good balance. We're seeing strong demand, particularly out of China, 13% import growth over the last 12 months. Good demand also throughout Asia, about 4% increase in demand. Importantly, on the supply side, New Zealand, clearly we've been struggling over the last 3 months or so, 6% down. Australia's flat. United States up about 1. And we are watching Europe carefully, particularly as we move into the European spring and into their summer. They're about 2% up over the last 3 months, and we'll be watching what happens there as we go forward. So that's a quick sort of look around the world, and we'll certainly be talking about that a little bit more for those of you that attend meetings. What I want to do now is flick across to Theo. Theo, those prices and how they're moving around has had an impact on the results for the first half year. Yep. Often we get volatility between the first half and the second half. This first half has been challenging. Just want to go through what the reasons for that are.
Yeah. First of all, in the first half, what you touched upon is the slow start of Q1. We had low inventories and also the weather. Milk came in quite late, so a bit of volatility there, John. But when you look at prices around the world, and the milk price products actually have been quite stable. So when you look at whole milk powder on this chart, then you see it's quite stable. Skim milk powder, slight drop, but that's because of the European situation and the intervention. But where you see an uplift in prices, in particular, is in cheddar. So that is driven mainly by the European situation, that we see better cheese prices. With better cheese prices means stream returns. So we saw 90 million stream returns in the first half of this year, which is positive. When you look a bit deeper to the fat products, we all have seen the lift of fat products last year. So you can see that here, that we actually look at 80% higher butter prices and only 18% higher cream prices. So in our business, John, between butter and cream, we saw quite some substitution, that people shifted in the mix and went away from butter and into cream, which had an impact on our total litre sold, which I will touch upon later on. So fat price is very, very high. Therefore, also input cost for our food service business very high, because that's mainly fat. And that had a pressure on our margin. But I will touch upon that in the numbers. So when we go to the numbers, I go straight into the numbers. So 10.5 billion litres of milk sold, that's 11% less, and that's mainly due to what I explained before, the cold spring and low inventories, low starting inventories for the year, because last year we ended really with a low inventory level and a very strong balance sheet, which we are going to do this year again. So the revenue line had a good uplift, 6% up, with volumes 11% down. So we're almost on that mark where we say $1 New Zealand per litre, where we want to be, or north of that. Margin impact, I will touch upon that later, mainly from consumer food service. OPEX slightly up, but under control. And then we come into the situation of our net profit after tax. So that's almost 250 million net profit after tax. That's 15 cents. Yeah, but we had to take, or we did take the impact of the known and being made, the impairment which we announced today. So when you look, and I come back on that in a minute. So when you look at the segments, ingredient had actually a very strong performance because the first quarter was difficult for them, given the weather circumstances, not a lot of milk. Quarter two was a very, very strong quarter. And the business of consumer food service really under a bit of pressure of that high fat price predominantly, but still made close to 200 million profit, which is, considering the circumstance, good, and we expect some tailwind at the back end. So going into the net profit after tax, so how did we go from 248 million plus to minus 348 million? And not all is cash impact. We will touch upon that later. The Danone arbitration is showing 160 here. That is cash out because that's money we paid. And the being made impairment, which we have taken of 405 and 28 million of losses of their operation, our share. That is the 433. The 405 million impairment is not cash. Yeah, there's an amendment of our balance sheet.
So clearly, Theo, that Danone result is disappointing. We touched on that in December, and at that stage we made the change in our forecast earnings range at that time. And you've just touched on the being mate result and the impact of being mate. We will be considering the full impact when we get to the end of year, which is normal practice. And that has all become into part of our considerations when we've declared the 10-cent dividend for the interim result. It's a prudent approach given the situation we're in, and you'll come through and explain that more in a moment.
Yep. And maybe to the slide we explain on the business on shifting volume to higher value. So quite tough in the first half. So food service showed the same amount of milk as what we did last year, but at much higher prices. And some pressure, of course, because we simply had less milk to sell this year, or this first half. Second half, we really expect a tailwind for consumer food service. It's already happening. We forecast 400 million litres of milk, like we target every year to go to consumer food service, and that's predominantly in the second half, and about 250 million litres in value-add or advanced ingredients. So in total, this year we estimate to shift 650 million litres to higher value. Maybe, John, before we go into the being made explanation, we have opted here to give you much more detail around our China or Greater China strategy and operation, because we are aware that you have been fed with a lot of information on Greater China, which is predominantly focused on being made and reflects onto our total Chinese business. We had a very good internal conversation to start sharing the different segments with you in China, and that's what you can see here. So these are half-year numbers. So when you look at these numbers, our ingredient business under NZMP did 2.2 billion litres of milk in only 6 months. Yeah, that's a very big number, and driving a gross margin for the co-op and for us of 216 million New Zealand dollars. Our anchor business, which is consumer and food service, did same as last year, 600 million litres in one half, and we delivered here a gross margin of 148 million. The business, or where we have being made in advanced nutrition, that's where we have much less litres of milk, but still a margin being delivered, including the impact of being made. And then our milk pools, I prefer to come back on that in a separate slide, because we're actually at a crossroad with our fresh milk to an era of great opportunity. When you look at the right-hand side, we have never said that China are different segments and different businesses. This is one business, one strategy, yeah? And we have explained that strategy in China to officials and to our stakeholders that we have that phenomenal ingredient business into China. We have a beautiful food service business into China, yeah? But it requires us to farm at scale, have a partner, and have safe consumer brands. And that's what you see here. It's not that we can unpick this strategy. It is one strategy and delivering value, and I will show you the economic or the enterprise value in a minute. So here you have, on the next slide, you see a bit more detail over the years and how we have evolved in terms of liters of milk being sold on the first chart. So we have an uplift of 45% in liters and 57% in margin. Yeah, these are numbers which we have not shared. We could not share them recently with all the noise because we are in a blackout period, but these are the numbers driving value for the co-op and for our shareholders. John, on the being made impairment, which is a massive number, the 405 million. Like I said, it is an adjustment of the value in our balance sheet, and it has to run because of accounting rules through the P&L. And we have adjusted the value of being made to 588, as you can see on this slide, or to 244 million of value of our investment. Do we still believe it's a strategic investment? Yes, it's a strategic investment. It fits into our Greater China strategy and our total value creation. Is there a big opportunity in the market? Yes, the market is growing at 7%. We have strong brand equity, but are we happy with the situation? Absolutely not. Is it fully on our radar and my number one priority? Yes, it is my number one priority. But we have slightly less than 20% shares, so we have limited influence. But we're using our influence to get the right things going, and you see that on the right-hand side. We're in a full, or in a process right now to appoint an independent CEO with a clear transition plan and a clear mandate to turn the business around. Because we operate in a very strong and good environment. We have good brands, and with good management, we can bring this company back on track. It has taken a long time. It's frustrating, John. There's a lot of noise around this, and that's also frustrating. But I mean, when you look at the Greater China strategy, it's part of the Greater China strategy, and it's not going well. Not everything goes well all the time, but it has full attention from us.
So it is a significant concern for the board. Clearly, from Theo's perspective, it's a major concern. We are very much still looking through this on a medium to long-term basis. There is a lot of work to occur. Being Mate itself has to address the concerns. There's opportunities in the market, but they have to significantly go through a transition, which they are giving us a commitment is underway. So it is an important part of the China strategy, but just trying to give some context here in the relative scale of it. None of us like being in a position where we've got to make a write-down like we have done, and we have to get this right. But the scale and the context of Being Mate in the wider China market, our business in China, and the value that has been created there certainly needs to be considered. So I just want to talk about our fresh milk and China farms, because that's also a significant move forward of where we're going and the overall value context of China.
Yeah, it's a big investment, and that's, like I said, part of our China strategy, which we started in 2012. So it's a big investment, but what we see right now in the market is that we see quite a dramatic shift in dairy from ambient products to fresh products. And China, in terms of food, is the largest fresh consuming country on the planet when you look at vegetables, when you look at fish, meat, etc. In dairy, we see that shift only now because of food safety issues before. But that shift is happening. You see the numbers here, quite significant shift to fresh. We have 400 million liters of milk. We can up, with our current investment, we could go potentially to 500 million. Yeah, and that is a lot of milk. But with our partnerships we have embarked on with Alibaba and with Starbucks, where we use our fresh milk, and if that footprint goes nationwide, then 400 to 500 million or in the near future could look like a small amount of milk in the context of China, because that's 50 billion liters of milk. So we have those partnerships that looks very, very positive, and that's what we have always said. Let's first farm at scale, go through the learning curve, and then connect it to downstream value with our key partners in China. And that's what's happening right now. That's good. So when you put all of these businesses into context and the greater China strategy, that's what we have to try to explain here in a very simple way. The value of Fonterra, that means share value plus debt, which we have, is 16 billion. When you look at our greater China enterprise, and it's broken down at the bottom of this chart, that's a 4.7 billion value business. So 25% of our liters sold, 1 in 4 liters, is China, and 25% of the value of Fonterra is China. And in that circle of China, you see being made, which we have, unfortunately, what John's saying, we have to bring that value down from around 650 million value to the 244 million. So that's the value of our greater China business. And that's very, those are the facts. This is, of course, not reflecting what's being said in the media.
So the context there is that over the last 3 years, essentially, we've had a growth of around about just over $1.1 billion of value in the China business that we, as Fonterra farmers, own, shareholders and unit holders. And importantly, that is taking into account, unfortunately, the write-down that we've had to take in being made. So just gives that context. I hope that's been helpful. Theo, do you want to move off China now and just quickly touch on Australia?
Yeah, I will quickly go through that. That's more of an update because we have been giving updates every half year. So that business is going strong. The ingredient business actually is gaining strength every year. We delivered in the first half 23 million of margin, and our consumer food service business has been stable compared to the year before. But the good news is, with all what's happening in that market, John, that we have taken much more milk. Yeah, we have taken about 400 million liters more milk, and we are now 22% market share and the #1 dairy processor, which what is very important, that milk is sticky and creates value, and that value goes back to shareholders. We have expanded, or we have rebuilt Stanhope, and we were always committed to the second phase. So there's a second phase on Stanhope, which is being executed. It's not this year, but it's over 2 years. So there's 125 million, and we're using about 40 million in Australia to debottleneck our existing operations, that we can take in more milk, which is still up for grasp for us in Australia. So more milk will deliver more value. So that business is going actually from strength to strength. But can we sit back and think this is a done deal? No, we can't. Yeah, so we have to be sharp. And then on to A2. I want to be quite brief about it. So it delivers an opportunity in New Zealand to really build the opportunity of the milk pool, that farmers can deliver A2 milk or supply A2 milk to us. We do have a deal with them for nutritional products to be produced in Australia and in New Zealand. Yeah, so the balance of what is produced where, we still have to work it out with them, but it's quite a significant business. We do have the opportunity in the future to go into other products like butter and cheese and even Chinese milk if we want to. And there's a New Zealand branded A2 fresh milk opportunity, which is close to us, which we need to implement.
And it's probably just worth touching on very quickly. We get a lot of inquiry from farmers as to whether they should be mating their cows to A2 bulls over time. Look, both A1 and A2 are going to be very important for us going forward. As Theo's just touched on, the A2 proposition is all about what is demand driven, and our Fonterra people will be talking to our farmers over the coming years as that demand grows, and we're looking for farmers alongside the plants that we're going to process this product. So this is a long-term venture, and we'll certainly keep in touch with you when we know what that demand for A2 is going to be. Thanks. Quickly cover the key numbers now, Theo, please.
Yeah, I think I've touched upon most of these charts when it comes to segment reporting. So ingredients, very difficult first quarter because of simply not a lot of product. Second quarter, very, very strong, and we are really focused on delivering similar results in Q3 and Q4, because we do have some milk still in our inventory. We kept it. We did not sell very aggressively ahead of the curve, but we sold a bit with the handbrake on, and now we can create better value. 90 million of stream returns, OPEX under control, so all in all, an uplift of the ingredients for the first half. Consumer, we see some pressure on volume because there's a shift between the highly priced butter to cream, and butter is 10 liters per kilo, and cream is about 5 liters or LMEs per kilo. So people, the cream portfolio actually sold well. Butter was quite stagnant because of the huge price uplift. That had an impact on volume. That will come back in the second half because butter prices have fallen a little bit. So we aim for 400 million liters of milk. But the most important part is here the margin pressure, which drove us down from 313 million to 193 million. But also we are positive about the second half. So looking to the regions of consumer food service, you can clearly see in China, we don't see the double-digit growth, but actually when you look at metric tons, there is double-digit growth, but we measure in LMEs, so that's what it is, 3%. Asia, 2%, South America, also 3%. So in the emerging markets, reasonable growth, not what we're after. We want to drive that harder in the second half, but in all regions, we see some margin pressure. And in Oceania, Australia is doing well in consumer food service, but in New Zealand, we definitely have pressure, operational pressure, and we are transforming that business back into where it should be, and that is 100 million EBIT business year on year.
I'll just quickly cover off the balance sheet. So we've seen the seasonal lift at the half year of our balance sheet, gearing at 51.6%, impacted by a few things. First of all, debt levels are up because of the Danone arbitration result. And also timing of CapEx. As we know, we've got builds going on at Cleanyboy and the Darfield cream cheese coming up. And also, of course, on the balance sheet perspective, the impact of the being made impairment. So 51.6% gearing at the half year. So it's already coming down as of today's meeting. Importantly, we do expect at the year end to be at that 40 to 45% range that we target. Very clear from management that that is where the target is, back down at that 40 to 45% by year end. We know it's been a challenging year on farm, as I touched on earlier. We also know that the first half of this year, we haven't had the performance that we'd like, but it was actually as per expectation, given, as Theo touched on, the low inventory coming in at the start of the year and the difficult first half year volumes. As Theo's touched on, we have to have a stronger second half year, and that is what is expected. I think pleasingly for us, even with the challenges that we've talked about, being mate, a lot of focus on being mate, the other challenges that Theo's talked about in the business, we're still seeing a strong forecast for the year in our dividend forecast range of 25 to 35 cents. And really important, everything we do every day is to maximise the payout, and our forecast for the year is $6.80 to $6.90. Of course, use the normal constraint and budgeting. We do know we've still got a few months to go, and it depends what happens a little bit with global prices, but we're confident around our $6.80 to $6.90 forecast for the year ahead. So thank you, Theo. Thank you for taking time today to listen to us. I do encourage you to get along to the meetings, and please, if you're coming along to the meetings, you need to RSVP because our team are trying to get all of that organised. So thank you very much. Thanks, Theo.
Thank you.